When a man sits down in front of a price chart with his nerves already jangling, he is not really trading the market at all. He is trading his own fear, and fear is a terrible thing to try to read with candlesticks. I learned a long time ago that the tape does not care how tired you are or how worried you feel about a bill due on Friday. It prints what it prints. And if you are stressed, you will see things in those prints that simply are not there. Have you ever noticed how a normal pullback starts to look like a crash when your mind is uneasy? Back when I was younger and more reckless, I thought I could will a trade into working just by watching it hard enough. I would stare at every tick, every little wiggle, as if my attention alone could bend the market in my favor. But stress makes you do that. It glues your eyes to the screen and makes you forget the bigger picture. You stop seeing trends and start seeing ghosts. Tell me, how can you judge the true direction of a stock when your thoughts are running in 10 different directions at once? The tape is like a river. When you are calm, you can see which way it is flowing and you can step in with it. When you are stressed, it looks like white water and every splash feels like danger. That is when traders jump in and out, paying commissions and slippage like a man throwing coins into a wishing well. They call it action, but it is really just panic dressed up as work. Have you ever caught yourself trading just so you would not have to sit with your own unease? I always said that it was not the brains that made money in the market, but the sitting, and sitting requires a steady mind. When stress comes in, patience walks out the door. You start grabbing at small profits, or worse, holding on to losing trades because you cannot stand the thought of being wrong today. The chart might be telling you clearly that the trend has turned, but your nerves are begging you to hope. And hope is not a trading strategy, is it? A stressed trader does not read the market, he argues with it. He looks at a line breaking and says, "It will come back." He sees volume drying up and says, "Just a pause." The market speaks in simple language if you let it. Higher highs, lower lows, support, resistance, accumulation, distribution. These are not complicated ideas, but stress twists them into a blur. Can you really expect to follow a clean trend if your mind is cluttered with worries that have nothing to do with price? I used to think that if I just learned more patterns, more indicators, more tricks, I could overcome any emotional trouble. That was a fool's dream. The best indicator I ever had was my own state of mind. If I felt rushed, angry, or desperate, I knew I was not fit to trade. Just like a sick man should not run a race, a stressed man should not be risking his capital. Why would you put your hard-earned money into the hands of a mind that cannot sit still? The market rewards those who can wait for the right moment, and stress makes waiting feel unbearable. You feel like you must do something, anything, to ease that tight feeling in your chest. So you take trades that are not quite right. The breakout is not clean. The volume is not there. The overall trend is sideways. But you click the button anyway, because doing nothing feels worse than doing the wrong thing. Have you ever noticed how the worst trades come from that restless urge? When you are stressed, even a good trade can turn bad. You get in at the right spot, the price starts moving in your favor, and then a small pullback comes. A calm trader sees it as normal noise. A stressed trader sees it as a threat. He dumps the position too early, only to watch the stock go on without him. Over time, that kind of behavior cuts deep into your profits, not because your analysis was wrong, but because your nerves could not hold. Isn't it strange how the market can be right and you can still lose? Wealth in trading does not come from cleverness alone. It comes from consistency, from following the same sound rules day after day. Stress breaks rules. It makes you bend them just this once, and then again, until you do not really have any left. You might size up too big, skip a stop, or chase a move that already ran. Each little mistake might seem small, but together they can drain an account. Would you trust a business partner who changed the plan every time he felt nervous? I always believed that the big money was made by catching the big swing. You cannot do that if you are glued to every tick. Stress makes you trade like a scalper, even if you want to be a position trader. You get shaken out of moves that could have built real wealth. The irony is that by trying to reduce short-term discomfort, You give up long-term gains. Have you ever stepped out of a trade too soon and felt that dull regret as it kept going without you? Reading charts requires a certain quiet inside. You need to see how price behaves around key levels, how volume confirms or denies a move. Stress adds noise to that picture. A little downtick looks like the end of the world. A small uptick looks like the start of a fortune. The truth is usually somewhere in between, but a stressed mind has trouble seeing grey. It only sees black or white. How can you trade probabilities when your emotions are screaming for certainty? There were days when I knew I should not be trading at all. Maybe I had taken a loss that stung, or maybe something outside the market was weighing on me. On those days, the wisest move was to close the book and walk away. Capital is precious. So is your mental energy. You need both to grow an account over time. Isn't it better to miss one day of trading than to spend weeks digging out of a hole you made while upset? The charts will still be there tomorrow. The trends will still be forming, whether you watch them or not. But your account might not recover so easily if you abuse it while stressed. A man who wants to build real wealth through trading must learn to protect his stake, not just from bad trades, but from bad moods. Do you guard your money with the same care that you guard your pride? Stress often comes from putting too much weight on a single trade. You start to think this one has to work because you need it to. That is a dangerous place to be. Every trade should be just one of many, a small bet in a long series. When you see it that way, losses do not feel like disasters, and wins do not feel like miracles. They are just part of the business. Wouldn't it be easier to stay calm if you did not hang your whole future on one price bar? A restless mind forces trades that the trend never confirmed, and that is one of the quiet killers of a trading account. When a trader cannot sit still, he starts to confuse movement with meaning. A few ticks up look like the start of a rally, and a few ticks down look like the beginning of a collapse. But the market does not move in straight lines, and it never has. It breathes in and out. It pauses. It tests levels. A calm trader understands this rhythm and waits for the chart to speak clearly. But a restless trader tries to make it talk before it is ready. Have you ever found yourself clicking the buy or sell button just because the price twitched and you did not want to be left out? Trends do not announce themselves with fanfare. They build quietly, with higher highs and higher lows, or lower highs and lower lows, confirmed by volume and time. But a restless mind is impatient. It wants certainty right now, not after the next candle closes. So the trader jumps into positions that have not yet proven anything. He buys before resistance is broken. He sells before support has failed. On the chart, those levels are still holding, but inside his head, they have already collapsed. That gap between what the chart shows and what the trader feels is where losses are born. Wouldn't you agree? The problem with restlessness is that it shortens your vision. Instead of seeing the whole trend, you see only the last few bars. You forget where price came from and what it had to do to get here. Maybe the market is still in a strong uptrend, pulling back to a moving average or a support zone. To a calm trader, that pullback looks like a chance to enter. To a restless trader, it looks like danger, so he sells right into support. Then, when the bounce comes, he feels foolish and jumps back in at a worse price. That is how small, harmless pullbacks turn into a series of costly mistakes, and all of it comes from not being able to wait. Every good trend has moments of hesitation. You will see candles with small bodies, wicks on both ends, volume that shrinks for a while. The market is deciding, gathering energy. A patient trader knows that these pauses are normal. A restless trader sees them as wasted time. He thinks, nothing is happening. I should be doing something. So he does something, even if the chart is telling him to do nothing. Have you ever noticed how the urge to trade often feels strongest when the market is actually the least clear? Confirmation is the market's way of saying, yes, this move is real. It comes in the form of a break above resistance, a surge in volume, a continuation pattern resolving in the direction of the trend. But confirmation takes time. It requires at least one candle to close, often more. A restless mind hates waiting for that. It wants to get in early, to be clever, to catch the exact bottom or top. In trying to be first, it ends up being wrong. There is nothing wrong with entering a little later if the move is real, but there is a lot wrong with entering too early when the move is still just a guess. Restlessness also messes with how a trader reads risk. When you jump into a trade without confirmation, you usually have no clear place to put your stop. Support has not been tested, resistance has not been broken. So you are trading on hope instead of structure. If the price moves against you, you do not know where you are wrong, so you hesitate to get out. Losses grow larger than they should, not because the market was cruel, but because the entry was sloppy. Wouldn't it be easier to manage a trade if you had waited for the chart to draw a clean line in the sand? The market gives endless opportunities, but a restless trader treats each one as if it were the last. That is why he chases moves that have already run far from any logical entry. The trend may be mature, volume may be fading, but the price is still going up, so he jumps in. He is not following a confirmed trend, he is following his own anxiety. When the inevitable pullback comes, he is trapped at the top, wondering how something that looked so good could turn so fast. A confirmed trend has a certain look to it. It moves with purpose. Pullbacks are shallow. Breakouts hold. Volume supports the direction. You do not have to force yourself to believe in it. The chart shows it plainly. But when you are restless, you settle for less. You trade half-formed patterns and weak signals. You convince yourself that this time will be different. Over time, that habit chips away at your confidence, because deep down you know you are not trading what you see, but what you want to see. There is also the matter of overtrading. A restless mind cannot stand to be flat. Being out of the market feels like being left behind. So you keep opening and closing positions, even when there is no clear trend to follow. Commissions pile up. Small losses add up. And because you never let a real trend develop, you miss the very moves that could have made the difference. Isn't it ironic that the need to always be in a trade often keeps a trader out of the best ones? Learning to wait for confirmation is not about being slow, it is about being selective. You are choosing to risk your money only when the odds are better. That is how wealth is built in this business, one chosen trade at a time. A restless trader, on the other hand, spreads his capital across too many weak ideas. He is busy, but he is not productive. The account statement, not the trading platform, tells the real story. The market does not reward activity, it rewards accuracy. And accuracy comes from letting the chart finish its sentence before you act. When you jump in mid-sentence, you might catch a word, but you miss the meaning. A breakout that closes strong means something. A breakout that fades back into the range means something else. If you act before the close, you do not know which one you have. You are trading a coin toss, not a trend. Emotional pressure leads to poor position sizing, and that is one of the most dangerous ways a trader can quietly hurt himself. Most people think losses come from bad entries or wrong market calls, but very often they come from being too big or too small at the wrong time. When your emotions are calm, you can look at a chart, measure your risk, and decide how much of your account belongs on that trade. But when you feel pressure, whether from recent losses, money worries, or the need to prove something, those numbers start to shift in your head. Have you ever noticed how easy it is to justify a bigger trade when you feel like you need a win? A good chart setup might tell you that a stock has broken above resistance with strong volume. The trend is up, the pullbacks are shallow, and the risk is clear. That is the kind of trade that deserves a normal, well-planned position size. But when you are under emotional strain, you might take that same trade and double or triple your size because you want it to fix something for you. Maybe you are trying to make back a loss. Maybe you are worried about your account. The chart did not change, but your behavior did, and that is where the danger lies. Position sizing is the bridge between analysis and reality. You can read the tape perfectly and still lose if your size is wrong. A small loss with a big position can do more damage than a big loss with a small one. Emotional pressure makes it hard to think in percentages and probabilities. Instead, you start thinking in dollars and feelings. You think, if this goes up just a little, I will feel better, so you load up. But that also means if it goes down just a little, you feel much worse. Do you see how quickly that turns trading into an emotional roller coaster? The market moves in waves, not in straight lines. Even the best trends have pullbacks. When your position is too large, those normal pullbacks feel unbearable. A move that should just be noise starts to feel like a threat to your survival. So you close the trade too early, often right before the trend resumes. The irony is that being too big makes you trade small, grabbing at tiny profits, because you cannot stand the heat. Over time, that habit keeps you from riding the moves that build real wealth. Emotional pressure can also push you in the opposite direction, making you too small when you should be normal. After a losing streak, some traders get so afraid that they cut their size down to almost nothing. They see good setups, confirmed trends, and clear risk levels, but they only take a tiny position. When the trade works, it barely moves the account. That can be just as damaging as being too big, because it teaches you to doubt your own analysis. Have you ever had a winning trade that felt empty because you did not put enough behind it? A trader who sizes correctly treats each trade as just one part of a long series. He risks the same small percentage of his account each time, regardless of how he feels. That keeps his emotions in check and lets the math of probability do its work. But when emotional pressure takes over, that discipline breaks. One trade becomes special. It becomes the one that has to work. And when a trade has to work, it usually ends up being the one that hurts the most. Charts do not care how much you bet. A breakout will either hold or fail. A support level will either bounce or break. The outcome is the same whether you trade 10 shares or 10,000. But your emotional reaction is not the same. A large position magnifies every tick. It turns small market movements into big psychological events. That makes it harder to follow your plan. You start watching the profit and loss instead of the price action. You forget what the chart is telling you and focus on what your account is feeling. One of the quiet skills of successful traders is knowing how much is enough. They know that even a great setup does not deserve their whole account. There is always another trade coming. Emotional pressure makes you forget that. It narrows your vision to the trade in front of you. You start thinking in terms of winning or losing, not in terms of executing a process. That shift in mindset is subtle, but it changes everything about how you size your positions. When you trade too big, you also tend to move your stops. A normal trader sets a stop based on the chart, maybe below support or above resistance. A pressured trader sets a stop based on pain. When the price gets close to that pain point, he moves the stop, hoping the market will turn. Sometimes it does, which only reinforces the bad habit. Other times it does not, and the loss becomes much larger than planned. That is not bad luck, that is the result of emotional sizing. Even traders who understand risk on paper can fall into this trap. They know they should only risk 1 or 2% of their account, but when they feel pressure, they find reasons to bend that rule. This setup is really good. They say, the market owes me one. But the market does not owe anyone anything. It simply moves. And when you bet too much on any single move, you are no longer trading, you are gambling with your emotions. Panic causes early exits from winning trades, and that is one of the most frustrating ways to fall short in this business. A trader can read the chart correctly, get into a strong trend at a good price, and still fail to make money because he cannot stay with it. The market starts to move in his favor, just as he hoped, and then a small pullback shows up. That pullback is normal, even healthy, but panic tells him it is a warning. So he closes the trade, locking in a small gain, only to watch the price turn, right back up and continue without him. Have you ever felt that hollow feeling when you sold too soon and saw the chart do exactly what you originally expected? Every trend breathes. It pushes forward, then it pauses or pulls back, then it pushes again. Those pauses are where weak hands get shaken out. A calm trader understands this. He looks at support, moving averages, and previous highs or lows to judge whether the trend is still intact. A panicked trader does not look at those things. He looks at his profit and loss. When that number starts to shrink, even a little, fear takes over. He is no longer trading the chart. He is trading his own discomfort. One of the cruel tricks of panic is that it feels like protection. You tell yourself that you are being smart by taking profits quickly. You think no one ever went broke taking a profit. That sounds wise, but it can be very expensive if you apply it to every trade. Big money in trading comes from letting winners run. If you cut every winner short, you need a very high win rate just to break even. Do you really want to work that hard for so little? A winning trade often does not go straight up. It might break out, run for a bit, then drift sideways, or even dip back toward the breakout level. That is the market testing whether the move is real. If the test holds, the trend usually continues. But panic makes the test feel like failure. You start to imagine the breakout was fake, that you are about to give everything back, so you exit right at the worst possible time when the market is gathering strength for the next push. Charts give you tools to stay calm if you use them. You can draw support lines, watch volume, and note how price behaves around key levels. If a stock pulls back on low volume and holds above support, that is a sign of strength, not weakness. But when panic takes over, you ignore those signs. Your eyes go straight to the red and green numbers. A few red ticks can erase all the green in your mind, even if the overall structure is still bullish. This is where many traders sabotage themselves. They do the hard part right. They wait for a setup. They buy a breakout. They enter a trend. But they cannot do the easier part, which is to simply stay in. Panic makes them snatch at small gains like a starving man grabbing crumbs. Over time, those crumbs add up to far less than the loaves they left on the table. The market has a way of rewarding patience. A stock that is in a strong uptrend will often give you multiple chances to get scared. It will pull back to a moving average. It will print a red candle. It will hesitate at a round number. Each of those moments is a test of your nerve. If you pass the test and hold, you are often rewarded with another leg higher. If you fail, you get paid in regret. There is also the matter of trailing stops. A well-placed stop, based on the chart, can protect you without forcing you out too early. Panic, however, makes traders move their stops too close. They want to lock in profit, but in doing so, they give the market no room to breathe. The first little shake knocks them out, and then the trend resumes without them. That is not bad luck, that is poor emotional control. Wealth in trading is not built by being right once. It is built by being right and then staying right long enough for the move to matter. Panic interrupts that process. It turns potential home runs into singles. Over hundreds of trades, that difference is enormous. A trader who consistently takes small profits and full losses will slowly bleed, even if his analysis is good. It is also important to remember that not every pullback is the start of a reversal. Real reversals have signs. They break support. They show heavy volume against the trend. They fail to make new highs or lows. Panic does not wait for those signs. It reacts to every wiggle. That is why panic traders often sell at the exact bottom of a pullback and buy at the exact top of a bounce. Staying in a winning trade requires trust, not in luck, but in your method. If you entered because of a breakout and a trend, you should exit because that breakout failed or that trend ended, not because you felt uncomfortable for 5 minutes. The chart should tell you when you are wrong. Your nerves should not. There is a strange comfort in being out of a trade. No risk, no worry. But there is also no opportunity. Panic pushes you toward that false safety. It whispers that it is better to be flat than to feel anxious. But if you are always flat during the best part of a move, you will never see what your account is truly capable of. Over time, early exits do something else that is harmful. They teach you to distrust your own good calls. You start to think that even when you are right, you cannot make money. That leads to hesitation, second guessing, and even more emotional trading. The real problem was never your entries. It was your inability to stay with them. Fear makes traders ignore clear support and resistance, and when that happens, the chart might as well be written in a language they no longer understand. Support and resistance are not fancy ideas. They are simply the areas where price has turned before, where buyers or sellers have shown their hand. They are the footprints of money that already moved. When you respect those levels, you are trading with the memory of the market. But when fear creeps in, those footprints get blurred and you start stepping in the wrong places. Have you ever watched a price approach a strong support level and felt scared enough to sell right into it? Support is where buyers have stepped in before. It is where selling pressure ran into a wall. When price comes back to that level, it often slows down, sometimes stops, and sometimes reverses. A calm trader sees there's a place to watch for a bounce or at least a pause. A fearful trader sees it as a place of danger. He imagines that this time it will break for sure, so he exits just as the market is finding its footing. Then, when the bounce comes, he is left on the sidelines, wondering why he did not trust what the chart was clearly showing. Resistance works the same way in reverse. It is where selling has overpowered buying in the past. When price approaches resistance, a thoughtful trader looks for signs of strength or weakness. If volume comes in and price pushes through, that is a breakout. If it stalls and turns down, that is a rejection. But fear does not wait for those signs. It assumes the worst. A fearful trader will cover a short or avoid a long just because price is near resistance, even if the market is building pressure to break through. The chart gives you these levels for free. They are visible to anyone who looks. Horizontal lines, previous highs and lows, trend lines, moving averages, all mark areas where something important happened before. Trading around them is one of the simplest ways to give yourself an edge, but fear makes you forget that edge. It makes you think that this time will be different, that the market will ignore its own history just to hurt you. When fear takes over, you stop seeing support as support and start seeing it as a trap. You think, what if it breaks? Of course it might break, but that is what stops are for. The right way to trade a support level is to define your risk just below it and let the market decide. Fearful traders do not do that. They get out early, before the level is even tested. In doing so, they give up the very trade that had the best odds. The same thing happens with resistance. A strong uptrend will often pause at resistance, then push through. That push is where momentum traders make money. But a fearful trader will sell right at resistance, even if the trend is strong and volume is building. He locks in a small gain and misses the breakout. Over time, that habit keeps him from ever riding a big move. Fear also distorts how you draw your levels. You start moving them to fit your emotions. A support line that was clear yesterday suddenly looks lower today because you are afraid the price will fall. A resistance line that was firm suddenly looks higher because you are afraid to buy. The chart did not change. Your fear did. And when you let fear redraw the map, you end up lost. Support and resistance are not guarantees. They are areas of probability. A trader who understands that can work with them calmly. He knows that sometimes they will fail, and that is part of the game. Fearful traders want certainty. They want to know that a level will hold or break. Since the market cannot give them that, they freeze or act too soon. Either way, they are not really trading the chart anymore. One of the most common fearful mistakes is selling into support after a drop. The price falls fast, emotions run high, and everyone starts talking about how bad things look. But the chart might show a major support level just below. That is often where big money steps in. A calm trader might even look to buy there. A fearful trader dumps his position right into that buying, giving his shares to stronger hands. Have you ever sold in a panic only to watch the market turn up almost immediately? Fear can also keep you from taking good trades at support. You see the level. You know it has held before. You see signs of buying. But you are too afraid to pull the trigger because the last trade hurt. So you sit there and watch the bounce happen without you. That is another way fear ignores the chart, by refusing to act when the odds are in your favor. Resistance is just as tricky. In a downtrend, resistance is where rallies often fail. That is a good place to look for shorts. But fear of being wrong can keep you from entering. You think, what if it breaks this time? So you do nothing. Then the price turns down, just as the chart suggested, and you missed another opportunity. The market is always balancing between fear and confidence, between buying and selling. Support and resistance are where that balance shows itself most clearly. If you ignore those levels because you are afraid, you are trading blind. You are reacting to price without understanding where it is in its larger structure. A trader who wants to build wealth has to learn to trust the map. That does not mean being stubborn. It means using support and resistance as guides and managing risk around them. Fear wants you to throw the map away and run, but running rarely gets you where you want to go in this business. Over time, ignoring these levels leads to a pattern of buying high and selling low. You buy when price is far from support because it feels safe when things are going up. You sell when price is near support because it feels dangerous when things are going down. That is the exact opposite of what the chart is telling you to do.